ticker tape starts dancing.
157 years. That's how long Goldman Sachs has been at the center of every major financial moment in modern history. And right now they're sitting at the epicenter of what could be the biggest M&A supercycle in a generation.
And they're not just watching from the sidelines. Goldman captured 36.4% of the M&A advisory market last year, pulling in $4.6 billion in advisory fees alone. When deals happen on Wall Street, Goldman gets a cut.
Today we're going deep on the firm that defines investment banking, the numbers, the risks, the catalysts, and whether that premium valuation is justified. I'm Hudson Thomas.
And I'm Lana Chen. Let's get into it.
All right, so Goldman Sachs, ticker GS on the New York Stock Exchange, founded in 1869 by a German immigrant named Marcus Goldman, who started by buying promissory notes from merchants in Lower Manhattan. That one-man operation eventually became the most influential investment bank on the planet.
Headquartered in Battery Park City, Manhattan, Goldman today runs 3 core business segments. Global banking and markets is the powerhouse. That's your investment banking, fixed income trading, equities, everything related to capital markets. Asset and wealth management handles over $3.5 trillion in assets under supervision. And then there's platform solutions, which includes their credit card partnerships and transaction banking.
And when you look at what makes Goldman relevant right now, it really comes down to timing. Treasury yields have stabilized in that 3.5 to 4.5% sweet spot, and that's unleashed a massive backlog of deals that had been sitting on the shelf. CEO David Solomon has called 2026 a top decile opportunity for M&A.
The AI infrastructure boom is a major tailwind, too. Goldman is facilitating mega deals focused on data centers, energy infrastructure, and the entire tech stack powering artificial intelligence. They're not just banking on traditional deal flow, they're at the center of the next wave of capital allocation.
And then there's the competitive moat, 157 years of relationships, the deepest Rolodex on Wall Street, and they've gone AI first internally, using models from OpenAI, Google, and Anthropic to automate pitch books, legal documents, and trading workflows.
Their main competitors are JP Morgan Chase, Morgan Stanley, and Bank of America, but Goldman occupies a unique position as the most capital markets-focused of the group. They're not trying to be a consumer bank. They're doubling down on what they do best.
So let's talk about the man running the show, David Solomon. He's been CEO since October 2018 and chairman since January 2019. Before Goldman, his resume reads like a Wall Street survival story.
Solomon started at Irving Trust, which he's described as his graduate school at a bank. Then he moved to Drexel Burnham during the junk bond era, right alongside Michael Milken's operation. When Drexel collapsed in 1990, he landed at Bear Stearns running their high-yield division.
Goldman finally recruited him in 1999, and he rose through the investment banking ranks to the top job. He's known as a modernizer, pivoting the firm toward more predictable fee-based revenue and bringing a more open culture to what used to be one of the most insular firms on the street. Oh, and he DJs on the side, which I still find incredible for the CEO of Goldman Sachs.
On the track record, his numbers speak for themselves. Full year 2025 earnings per share grew 27%, return on equity hit 15%, and he's positioned Goldman squarely at the center of the M&A renaissance.
All right, Lana, this is your domain. Walk us through Goldman's financial picture.
Let's start with valuation. Goldman shares are trading around $864.68 as of today, with a market cap right at $250 billion. The trailing PE sits at 17.88, which is actually 42% above Goldman's 10-year average of about 12.5. Forward PE drops to around 14.75, which tells you the market expects meaningful earnings growth ahead.
So they're trading at a premium to their own history. Is that justified?
That's the key question. Price to book is 2.23 and EV to revenue is 8.41. For a bank, those are elevated multiples. But look at the income story. Trailing 12-month revenue came in at $58.28 billion, with year-over-year growth around 16%. Earnings per share at $51.32 for the full year, up 27%. Net margin is a pristine 32.6%, and operating margin is 37.5%.
Those margins are impressive for a bank of this size.
They really are. Return on equity at 15% is above the sector median of about 12%. Now, cash flow for a bank like Goldman doesn't work like it does for a tech company. Their free cash flow is negative $47 billion. But that's standard accounting treatment for financial institutions. Deposits and lending activity flow through those numbers. What matters more is profitability and capital adequacy.
What about the balance sheet?
Total debt is around $619 billion, which sounds enormous, but Goldman is sitting on $153 billion in cash and cash equivalents. For a systemically important financial institution, the balance sheet is well capitalized. They're also paying an $18 annual dividend for a 2.1% yield, and they've got a buyback program that could retire 5 to 6% of the float.
So the numbers are strong across the board.
Overall, Goldman Sachs's financial health is strong. Record earnings, best-in-class margins, and a capital return program that's accelerating. The premium valuation reflects real operational excellence, not just market enthusiasm.
So how are the analysts reading this? Where does the street come down on Goldman?
The consensus is hold, but it's a nuanced hold. Out of about 20 analysts covering Goldman, 6 have buy ratings, 12 are at hold, and 2 are at sell. The average price target is around $960, which implies roughly 11% upside from today's price. The range is wide, though. The low target sits at $700 and the high at $1,125.
Any notable recent calls?
A couple worth mentioning. Evercore ISI maintained their outperform rating but just lowered their target from $1,075 to $950. Jefferies also maintained buy but trimmed from $1,125 to $1,049. Both firms are still bullish on the M&A cycle, but are recalibrating after the run-up from the 52-week low of 447 back in April 2025.
Right, this stock has nearly doubled in a year.
Exactly. On the earnings front, Q4 2025 was a mixed bag. Revenue came in at $13.45 billion, which actually missed estimates, partly due to the Apple Card portfolio exit. But EPS of $12.41 beat expectations, and the full-year numbers were strong enough that analysts are looking past the Q4 top-line miss. All eyes are on April 13th for Q1 2026 results, with the street expecting about $16.65 billion in revenue.
All right, let's lay out both sides of this trade. I'll take the bull case. The biggest thing working for Goldman right now is the M&A supercycle. Deal flow is at record levels. Healthcare, energy, and AI infrastructure are driving massive transactions, and Goldman's 36% advisory market share means they're capturing the lion's share of fees.
That's fair. And on top of that,
The shift toward asset and wealth management gives them more predictable, fee-based recurring revenue. They're scaling past $3.5 trillion in assets under supervision. The buyback program is aggressive. Retiring 5 to 6% of float supports EPS growth even if revenue plateaus. And the AI integration internally is a genuine efficiency multiplier. They're automating the grunt work and letting their people focus on high-margin advisory.
now for the bear case. First, that premium valuation, 17.88 times trailing earnings, is 42% above Goldman's historical average. If the M&A cycle cools or capital markets pull back, those multiples could compress quickly. Second, insider selling. Over $112 million in C-suite stock sales in Q1 2026 alone. The CFO, the chief legal officer, executive vice presidents, they're all trimming. That's not a great signal when you're asking investors to buy at these levels.
Devil's advocate. Couldn't that just be planned selling after a big run-up?
It could be. But the volume and breadth of selling across the C-suite is notable. Third, Goldman has significant exposure to private credit markets, which are now north of $2 trillion. If AI disruption starts impairing borrower credit quality in certain sectors, that's a risk. And finally, regulatory pressure is always a factor. Compliance costs keep rising, and any new capital requirements from regulators could limit returns.
Let's see how Goldman stacks up against the competition. We're looking at Morgan Stanley, JP Morgan, and Bank of America.
Starting with valuation, Goldman's 17.88 trailing PE is the highest in the group. Morgan Stanley trades at 16.25, JP Morgan at 14.11, and Bank of America at 12.9. So Goldman commands a clear premium. On revenue growth, Goldman's 16% year-over-year leads the pack. Morgan Stanley is around 12, JP Morgan at 10, and Bank of America at 9.
So they're growing faster, but also more expensive.
That's the trade-off. Morgan Stanley is the closest comp. They're a wealth management powerhouse with about $74 billion in projected 2026 revenue. JP Morgan is the fortress balance sheet with massive scale, but a more diversified deposit-heavy model. Bank of America trades at the biggest discount because they're most exposed to net interest income headwinds. Goldman's premium is justified by their capital markets first model and M&A dominance, but it also means there's less margin for error.
What are options traders telling us about Goldman heading into earnings?
The put-call ratio is at 0.95, which leans slightly bullish, more call activity than puts. What's really interesting is the implied volatility percentile, which is sitting at just 6%. That means IV is near the lowest it's been all year. Options traders are pricing in very little expected movement.
So the market is calm heading into earnings.
Remarkably calm. On the call side, the biggest open interest clusters are around the 900 and 950 strikes. On the put side, the 800 and 750 strikes have the most activity. So options traders are positioned for a fairly narrow range, roughly 800 to 950, heading into the April 13th report. But I'd add the usual caveat: options flow is a snapshot, not a forecast. It tells you what traders are hedging for, not what will happen.
Insider activity at Goldman has been making some headlines recently.
And not for the reasons bulls want to hear. Over the past 6 months, there have been 0 insider purchases and 8 significant insider sales totaling over $112 million. The biggest seller was Executive Vice President John Rogers at $15.2 million, followed by CFO Dennis Coleman at $10.9 million, and Chief Legal Officer Catherine Rumler at $8.9 million.
That's a lot of executives heading for the exit at the same time.
It's worth some context, though. Goldman's stock nearly doubled from its 52-week low of 447 to current levels. After a run like that, planned sales are common, especially after bonus and equity vesting periods in January and February. That said, the complete absence of any insider buying does stand out. Typically, you'd see at least 1 or 2 officers expressing confidence with open market purchases. The lopsidedness here is worth noting.
Let's talk about what could go wrong and what to keep an eye on.
Risk number 1 is straightforward: a capital markets downturn. Goldman's revenue is heavily tied to deal activity and trading volumes. If equities pull back or the M&A pipeline stalls, the numbers get hit immediately. Second, that insider selling pattern we just discussed. It doesn't necessarily mean the stock is going down, but it's a data point that investors should weigh against the bullish narrative.
What about the macro picture?
Geopolitical volatility is the third risk. Rising tensions can compress margins through higher compliance costs, insurance premiums, and trading desk volatility. Fourth, private credit exposure. Goldman is a major player in the $2 trillion private credit space, and any systematic credit deterioration could create problems. And fifth, regulatory risk is always present for a systemically important financial institution.
And on the catalyst side, what should investors watch for?
April 13th earnings is the immediate catalyst. The street expects $16.65 billion in revenue, and a strong beat could push the stock toward that 950 to 1,000 range that several analysts are targeting. Beyond that, watch the buyback cadence and any updates on the asset and wealth management growth trajectory.
All right, let's bring it all together. Goldman Sachs is the most storied name in investment banking, and right now the numbers back up the reputation. Record earnings, dominant M&A positioning, best-in-class margins, and a CEO who's leaning into the cycle.
But the stock is trading at a meaningful premium to its own history and to every major peer. Insider selling has been heavy and one-sided, and the firm's revenue is inherently cyclical. When deal flow is hot, Goldman prints money, but cycles turn.
So the one metric to watch?
For me, it's the Q1 2026 revenue number on April 13th. If Goldman delivers on that $16.65 billion expect beats it, it validates the M&A supercycle thesis and supports the premium multiple. If they miss, the air comes out of the valuation argument quickly.
I want to leave you all with a quote today. Warren Buffett once said the most important quality for an investor is temperament. not intellect.
And that feels especially relevant for Goldman right now. The fundamentals are excellent, but the question is whether you're paying a fair price for excellence and whether you have the temperament to hold through a cycle that could turn at any moment.
Couldn't have said it better. That's going to do it for episode 89 of Charged Alpha, our deep dive into Goldman Sachs, ticker GS. If you got value out of today's episode, share it with someone who's looking at the financial sector, and leave us a rating wherever you listen. It helps more people find the show. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.